Hi everyone, welcome to the webinar. Slightly unusual one, this, in that it's a Ask Me Anything. I've got some slides I want to show you as well, but I want to focus on emphasizing your opportunity to ask me any questions about the market at all that you wish as well. Okay, so you should be able to see the opening screen. The main focus of this webinar, as is with all of mine, is to make sure your money's working hard as possible for you. In the bigger picture, it is because for me, certainly investing and trading has been the route to social mobility. And so there is a bigger picture to all this. So going back to all of what I want to go through in this, I'm going to talk a bit about investing, a bit about trading, where I'm on the markets, what I see as my views, but also lots of questions I want to read and see from your good selves as well, please. So just to kick off, here we go. Investing to make your money work harder. As everyone settles down, just a quick update. This is not financial advice because I don't know your individual personal circumstances. Okay, so that's what that screen says. It says it's not individual financial advice because I don't know your individual scenarios. Michael, hello. Delighted to read and see you're from Malta. And please, people, let me know where you're from as well so that I know that you can see and hear me. I always tell people, if you want to gamble, if you want to double your money by tomorrow, if you want to take too much risk, please leave. There is a relationship between time and risk. The shorter the time frame, the greater the risk you will not achieve a certain goal. It's just mathematics, okay? And for that reason, if you want to, get a bigger return in a shorter time frame, which we all do, we all want massive returns in the shortest possible time frame. That's the highest risk. Okay, it's as simple as that. Nitin, hi. Of course, you're from Budapest. We've got Birmingham, Hertfordshire, Hornchurch, Yorkshire. Phil, yes. Represented, and Wade, of course, from the United States. Well, speaking of the US, I put a poll up there. Will Trump win the election in 2020? To get your views on that, just out of interest. Okay, now before I give you my views on the investment and trading side of things, I just want to remind people of this. This is from Goldman Sachs Asset Management. Okay, it's from Goldman Sachs. It's one of their slides. I love stealing slides from the likes of Goldman's or JP Morgan. We'll keep it our little secret. I think that knowledge should be shared. I'm sort of the Robin Hood of investment slides. Steal from the big rich asset management companies to give to everyone. Okay, and the reason I want to share this slide with you is it's not controversial. It's not controversial at all, and it's standard practice. And what it basically says is this: depending on the number of years to retirement. Now, let's assume I've got 25 years to retirement, for argument's sake, okay? Then this is what you should be doing in terms of equities and fixed income. All right. So for somebody like me, it's saying I can have about 85% in equities, but I could go as high, and that's called tactical. I can go as high as 100% in equities or as low as maybe 75% in equities. I'm risk loving, so I've got 100% in equities. I don't have anything in fixed income. For fixed income, you can read corporate bonds if you know what they are. If you don't, you can read bank account. All right, something which is safer. Now, if you're at retirement, why would you have so much more in fixed income? The idea is you might need something for an emergency. You need it by tomorrow. You can't wait for a riskier investment like an equity investment, even in a Microsoft. If it goes down in a year, you can't wait a couple of years for it to come back. You want to know for certain how much money you've got, hence the fixed income idea. This is conventional wisdom. Now, Warren Buffett believes that actually a lot of equities in a diversified portfolio behave a bit like bonds or fixed income. They generate pretty steady income or capital plus income, all right? And yes, they can fall as they did in March in the case of, say, even a Microsoft, which is, by the way, the reason I keep mentioning Microsoft is the safest company I can think of. If you can think of a safer company, good for you. I just think it's the safest company I can think of. Got $1 trillion in the bank. It's just used as a sort of an example, an illustration. And he said, actually, you don't need fixed income. You just put in equities, you diversify, and you'll get a similar kind of flexibility. All right, I just wanted to share that with you, partly because I think the slide's really good. It's conventional wisdom, but I think what Warren Buffett says is very useful and good on that. By the way, on that poll, only 25% think Trump will win. Now, obviously, most of you on this webinar probably can't vote in the election. Wade, I know you can vote in it, but it's just interesting. I'm not going to say much about it at all. I've got other questions. Rupin's asked me, how do you get a decent return in fixed income in low interest environment? You don't get a decent return. You get the certainty of knowing that there won't be much volatility. By the way, low volatility means more certainty, obviously. Okay, and because you've got lower volatility, you get lower return. You know, in the ideal world, we all want 100% return by tomorrow morning, or we want a guaranteed return, right? And we want that return to be high. Well, guaranteed returns don't come with high returns, all right? So don't worry about that part of things. You can't. You can't. It's as simple as that. If you want fixed income, you want a bank account. That's, again, why Warren Buffett, who's a big fan on equities, would say to you, well, the closest you're going to get to fixed income, in his view, and I don't think I'd be putting words in his mouth, he'd say, you know, a Microsoft, and he's big friends with Bill Gates, or an Apple, and you might turn around and say, hang on, that just dropped 10% over the last couple of weeks. And he'd say, yeah, you're right. But to him, a 10% drop's neither here nor there, because over the longer term, you've got so many profits accumulated in it. Do you see what I'm saying? He would sacrifice the certainty and the low return in order for a little bit less certainty, but a bigger return, knowing that even if it fell as it did in March, well, at least you have gains before and after that. All right? You have gains before March, which cushion the falls, and you had it recovering pretty quickly after it. So yes, it can fall, but you've got gains before and after. That's the Buffett measurement. Now, Julian's asked a question, which I'm going to answer in a second, which is, assuming Trump will win, how should you adjust your portfolio? And I'm going to answer that brilliant question in a second, Julian. First of all, I want to show you the Dow. Okay, so this is the Dow, and you might not know this. The Dow is only composed of 30 companies, okay, in the US. And it's, is it a barometer of something? Well, it's a barometer of those 30 companies, right? And this is where it was in 2009. So we're talking about after the financial crash, and it's just been doing this. All right. So it's gone from, God knows what it was back then, 8,000 to nearly 30,000. Yeah, I know. In just 11 years, 8,000 to 30,000. And that's Warren Buffett's case. If you just had a basket of stocks, yes, sure, unlike bonds, they fall, but look at the gains you have beforehand and the gains you have after, which cushions things. Okay, so that's, so I'm just, yes, I'm biased as well towards equities over bonds, but I'm just putting it in these terms and comparing it and contrasting it to what Goldman Sachs says. Right, so this is where we are with the Dow. Now, we had a great question. Now, Rupin said, is it relevant? Well, it is. If you own the Dow, if you are tracking the Dow, it's very relevant because you just got from 8,000 to 30,000. Okay, so there you go. It's relevant because you just went from 8 to 30. You pretty much quadrupled your money. That's relevant, I think, quadrupling your money in 10 years. Okay, so there's an example of what it is. I'm not reading into that, what it means for the broader economy or not. What it means is you quadrupled your money. What does that mean? Well, it means you quadruple your money. Nothing else. I'm not reading anything else into it. All right. That's where we are with that. I just want to give an example of where we are now. People ask, can it continue going higher? And this is the idea with, well, what if Trump wins? Will there be looser fiscal policy, monetary policy? Will he fuel debt as he did in his business and therefore lead to greater buoyancy in the US economy? Or will he start a trade war with China, no more elections to fight, clamp down on this, that, and the other, and ruin the economy? All right? I don't know. What I know is there's a bunch of people who think one thing, there's a bunch of people who think the other. Therefore, I'm not going to try and gamble, around whether he's going to win or not, and what the outcome might be. If I was on TV, if I was on the BBC right now and they asked me, what do you think? I'd say, I think he's going to win, and I think the market's going to rally if he does. Now, most of you on this are going to start shouting at me and screaming me as a massive orange racist or something. I don't care. That's not my point. My point is very simply what I think is going to happen. That is irrelevant to my investment decisions. And I'll tell you why it's irrelevant to my investment decisions. My investment decisions are actually, when it comes to putting my money where my mouth is, I don't know if he's going to win, and I'm not going to gamble on it. Because if I want to gamble on it, I'll go to Ladbrokes. So what I'm going to do instead is look at specific individual stocks to make sure, should he win or not? Should a whole bunch of people hate if he wins or hate if he loses? That my stocks will have a cushion and they'll recover. In other words, if they fall, they won't fall as far as many, and they'll recover quickly. It's the only two things I can do, right? Things will always fall. There is no guarantees that it falls, so I've got to make sure it doesn't fall as far. So how do I find those stocks? And I've got to make sure they rebound quicker. So how do I find those? They're the only two things worth having. Doesn't fall as far, rebounds quicker, right? I'm not here to gamble. Now, some people are here to gamble. They want to gamble around whether he's going to win or not. Great for you. I don't want to do that, right? Never have, never will. Warren Buffett doesn't want to do that. Never has, never will. I'm not a speculator. I'm not a gambler. I like safety because it's my money. It's my son's inheritance, all right? I want stocks which, given that I know they're going to fall, won't fall as far, right? So I don't want gambly stocks because I know stocks can fall. So I don't want to be lumbered with them for 50 years if they fall and thinking, oh, please, God, go up. And I need them to rebound quicker because I'm getting old. Life's too short. I don't want to wait holding them forever. Got it? So I'm going to look at individual stocks. I'll tell you which ones, and I'll tell you in a second why and how I find those. Those are things which I think are important, what I've just said to you, right? This is the Footsie, by the way. Footsie 100. This is where we are at the moment, and it's pretty much where we were back in 1999. If I had a time machine, I wish I would go back to 1999, just for no other reason than I'd be in my 20s. So lovely. But right, what's going to happen here? Well, you know, if you really want me to, I could try and make a case for how we're oversold and we'll rebound up, and you know, after we've got some Brexit certainty, or even if we get a hard exit and the pound falls, the Footsies will surely rise, or we get certainty and we don't get a hard Brexit, the Footsie would rise. Either way, it's bound to rise, would be a thesis. I'm not going to gamble on that. I don't gamble. I just told you. I could say, well, in the past when we've had these low oversold levels on technical indicators like this, the market has tended to very quickly rebound. I could make that thesis and pretty pictures. All very good. I don't want to gamble on any of that. So I'm going to, again, have to look at what would cause any of the stocks I hold not to fall as far, rebound quicker. So I'm going to look at valuation, growth, income, momentum, cash flow, volatility of the company, all of these factors, and filter. So I'll give you the names of what I would look at, okay? Now, within the Footsie, you've got things like Barclays, right? And people are saying, well, why is the Footsie dragged down? So I don't want to look at the index. As Rupin said, is it relevant? Are indices even relevant? To expand out what you were saying in a way. Is it even relevant? Well, this is Barclays. And you might say to me, Alpesh, I've got a whole bunch of stocks like this in my portfolio. I've got a whole bunch of stocks, which a moment ago, they were, you know, at what, 600 or even at 200 at the start of the year. And now they've halved. I've got 50% down on a bunch of stocks. What the hell do I do? Right. Well, ideally, you wouldn't be in that position at all. Would you buy it now? Now, the only time I look at something like this, and if somebody puts a gun to my head, I say, look, you might want to put a special situation strategy where you say to yourself, it's at 100, it's not going to go bankrupt, but let's assume it could go to zero for just for a second. It's not going to, but let's say it could. Then I've got a risk of 100. Let's say if it gets back to 200, where it was in January, even if it takes 3 years, I'll get the hell out of there. All right. So at least from 100, I'll double my money. So whether you hold it or not. Now, that's a special scenario. It's not one I'd want to enter into today because I don't like entering into distressed prices. I don't like doing that. I don't like holding on to companies which are not doing too well. But if somebody, like I said, put a gun to my head, I'd say, look, at some point in the next 3 years, I would estimate it's going to go back up to where it was. Now, when it goes to 200, don't bloody hold it and say, well, it was once at 400. It once was at 600. Oh, remember the heydays of when it just used to prance around at that? No, forget all of that. Forget all of that. Just that's a special situation scenario, and that is that. Okay. Now, I've got another question. If Trump wins, it will be good for the market. Well, there you go, Roman. And there's 50% of the Americans, Democrats, who you will say are wrong, who are saying, no, it won't. Now, personally, I think you're right. I don't think it'll be good for the market. Well, I think it'll be good for the market in this sense. The market will perceive it as good for itself, and therefore it will rally. Okay? But I'm not gambling on that because you never know what the market's going to bloody think. So I still need to buy the same stocks I need to do whether Biden wins or Trump wins. I still need the same companies. Right? Because I'm not gambling on one win over another. Because like I said, if I wanted to gamble, I'd go to Ladbrokes or whatever the American equivalent is. Okay? So exactly. Rupin says, how do we know what? The kids ask, with the vaccine on the horizon, Would you rotate into airlines? There's a problem there. Let's say there's a vaccine in January. Okay, there's some rumors that there might be a vaccine in January. I'm gambling whether it happens or not. Would I rotate into airlines? I'm gambling. It's too much of a gamble. The only way I would do airlines, if I say to myself, kid, I'm going to gamble on airlines. That's the only way I would do it. I can't justify airlines based on revenue growth, right? No, can't justify it on dividend yields. I can't justify it on volatility. Can't justify it on average return. Average returns aren't great. Can't justify it on cash flow. Are you kidding me? So what am I doing it on? The only reason I can justify it on is, hey, let's throw the dice that there's going to be a vaccine. But I don't want to gamble. If you want to gamble, go to Ladbrokes. In my experience, 99% of private investors want to gamble. They actually want to be at Ladbrokes, but they want to play it on the stock market. That's not what we're here to do. Okay, so I'll tell you some of the more certain companies that I like the look of at the moment. Now, the reason all of this is important is this. Yes, there are market falls and rises. This is the NASDAQ in blue, the S&P 500 largest US companies in orange, and the UK broader market in red. Okay, so the UK over the last 5 years down 21%, the NASDAQ up 34% over that period. All right, that's fine. My point here being that, yeah, markets fall, they recover. There's a poverty gap. The poverty gap, sorry, I beg your pardon. That was year to date. This is year to date. This is just year to date. Year to date, NASDAQ up 34%, UK markets down 21%. Year to date, okay? Let's go back 5 years instead. This is 5 years. Over the last 5 years, NASDAQ up 170%, the UK down about 8%, okay? And the S&P 500 US companies up 72%. That's the poverty gap between focusing only on your domestic market. Most of you are UK. Okay? If you only invest in your UK markets, then you're missing out on the whole world out there. I'm British. I want to own. I'm imperial in my mindset. I want to own and have people working for me from all over the world. So I want to be looking at wherever the money's to be made. In this case, it happened to be NASDAQ. I am not jingoistic, nationalistic, racist. Or I'm not, let's be clear, I am not racist in my stock picks. I do not say, oh, that's an American company. I'm not buying it. That's an Indian company. I'm not buying it. I'm only buying British because actually those British companies are exporting around the world as well. Okay, so since I'm not nationalist or racist in my stock picks, I'm just mercantile and want to make money out of it. This is, in one sense, why. I do not want your pensions, your savings to have this poverty gap. Because 5 years go like this, and you look back and you go, shit, that Alpesh is up 170%, and I'm down 8%. I've just wasted 5 years of my life. And you know what the funny thing is? To save the money that you would have started this period with, you worked your whole life. You worked your whole life to save the money, and then for the last 5 years, you didn't have the money working for you. All right, you could have, it's basically like having working two jobs at the same time. Your money's working one job, you're working your day job, but you didn't have your money working a second job. It lost 8%. So don't just look at the domestic markets. I'll tell you which ones I particularly like at a second. Rupen's asked, why does the UK underperform? A whole host of reasons. Some to do with technology, some to do with venture capital, some to do with the culture, political culture, commercialization. Doesn't matter in a sense. The great thing is UK investors like you and me, Rupen, can invest in global companies. Michael, I understand the government has written the banks are asking whether they're prepared negative rates. Is this a concern? It's a tough one at the moment on the negative rates issue. I can't comment on that at the moment, and that's why I'm not investing in banks anyway. The reason I gave you Barclays as an example, I mean, let me put it this way, Michael. I've got a choice between Barclays, love the company, not the share price. I don't like the share price. Look at the share price. I'm not an idiot. I don't like the share price. I like the people who work in Barclays. My friends work in Barclays. I love the company. I love the brand name. I love the Britishness of it. Okay, but I don't love the bloody share price. So if somebody said to me, Barclays or Microsoft, Barclays or Apple, oh, come on, which do you think I'm going to go into? But you know what the funny thing about private investors is? Go, oh, I'm going to go at Barclays because I'm British. Yeah, what about Apple, Amazon, Costco, Square? Nah. I want to go for I'm like a moth. I'm like a turkey, and Christmas is coming. I don't know why they do it. They gamble. I don't know. Humans are naturally speculative, I've discovered. They're actually really risky people. It's amazing the species has survived so long. Maybe it hasn't. 100, right? The only way I would do Barclays, if somebody put a gun to my head and said, right, you got to put it in Barclays, give me a strategy. And I'd say, okay, strategy I'm going to give you is this: 3 years. If it goes within 3 years at any point to 200, get the hell out. You'll have doubled your money. If it doesn't, you might end up in 3 years at, not much, but there you go. It's the only way I'd do it if they put a gun to my head. All right. That's my view at the moment. So there is a strategy, but yes, Tanya, there will be a recording. Don't worry, there'll be a recording of this. You'll get an email on that. Now, so which ones do I like at the moment? Okay, this is from the Dow 30. Right now, everybody on here is one of my students. Okay, so you're all my students anyway. So anyway, look, this is the Dow. So I've gone at the ones which have either a 7, 8, 9 on the valuation growth income momentum, high cash flows are up over the last 6 months. Sortinos, I want that to be green as well, ideally. I want the alpha ability to outperform the market to be green, etc., etc. And you can see some names. Okay, and if somebody said to me, my aunt said to me, Alpesh, see the ones which have got all greens, I'm thinking of buying them. What do you think? I'd say to my aunt, that's fine. That's fine. I don't have a problem with any of these. Okay. Jonathan, I'll read your question out in a second and answer it. I'd say I don't have a problem with any of these. Okay. Now you might flavor these to taste. You might say, screw it, I don't want Home Depot. Okay, let me just show you, because you might be like me and be more tech biased. I'm very tech biased. Okay, so this is the NASDAQ 100. Now you might say, wait a minute, NASDAQ, isn't that all technology? What the hell's Costco doing on there? Well, it isn't just technology, it's just technology heavy. Okay, I've done a similar exercise: valuation, growth, income, momentum, yields, cash flow, so on. These are not recommendations for you. I'm just saying what at the moment, based on traditional education of the markets, and traditional education of the markets tells you that alpha means the outperformance, Sortino means a high average return and low volatility. 6 month performance means 6 month performance. Croaky means cash flow, the ability to generate cash in this market, very important. And I've also put into a single score valuation, growth, income, momentum. Well, these numbers are up there. Okay, now this is not a recommendation. Don't go and buy these. I'm just saying these are the ones which at the moment have some of the highest ratings, right? I happen to own some of those. Okay, this is what I happen to own. This isn't all I own. It's some of the ones I happen to own. These are big multi-billion-dollar companies. You're not going to, by buying them, push the price up for me. Okay, these are not N companies or penny shares, which I'm trying to ramp up. These are PayPal. You go and buy it, unless you happen to be George Soros watching this and put $1 billion in there. You're not going to move the needle. So while you take that in, Jonathan. Jonathan, I'm trying to get regular income. Yeah, of course, hopefully capital gains. Could you do this? Buy, say, iShares DAX at present level, then sell the equivalent value of November calls, approximately 6% higher. Calls, writing calls against the underlying strategy. Email me, Jonathan. It's going to be a bit technical to talk to people here about it. What you're talking about is writing covered calls. Okay, it is possible, but it's really for sophisticated investors. So let's say you owned 1,000 shares in Apple. The covered call is you sell calls. In other words, you receive a premium, and if the price of Apple rises, somebody can take those shares off you. But you're happy because it's risen a bit, but it means you're capping the potential gain you could otherwise have had. If the price of Apple falls, then you get the premium from the option, but you've got a loss-making share, which you might be fine with because you'll say, it's Apple, I'm going to hold it forever. And it can be a good strategy as long as, in my view, it's the kind of stock you intend to hold forever and you don't think it's going to massively rally and you don't mind capping some of your gains. Dan, comment on the question. Isn't the only reason I stock prices the potential for gains? It's irrespective of location or sector. It's surely about company fundamentals, business, and future outlook. You're absolutely right, Dan. It is about all of those things. It's not to do with geography. It's just coincidence that over the last 5 years, geographically, this is the difference. And it tends to happen every year, not to do with geography. You could argue, Alpesh, what's geography got to do with it? Well, all I'll say to you, Dan, is every single rolling 1 year period, certain geographies outperform certain others. I'm not saying go into that geography. I, like you, Dan, take a bottom-up approach, which is I don't care if it's an American company. I still need it to outperform. My point to everybody is this: please don't just look at your domestic market, because if you look at just your domestic market, statistically, you will have fewer companies. That's just mathematics. You have fewer companies in Britain than you do in Britain plus America. So if you're looking at fewer companies, you've got less opportunity of choice. If you've got less opportunity of choice, then your quality, like interviewing people, will diminish. So it's really, the point I'm making is not, hey, let's fly the American flag or the British flag or whatever. It is, let's just make sure we've got a lot of choice. That's all. Tanya, which are good places to read about spread betting and CFDs with examples? Tanya, the free sites. So that, just email me. You're on the program. You're one of my students. My sites are the best free places to read about spread betting CFDs with examples on there. Ash, I assume the presidential cycle and year end should push the Dow up. How would you trade the index spread bet ETF or just individual stocks? Ash, individual stocks. I'm not gambling on the outcome of the election, as I said. And certainty, one would think, will boost the market higher. Equally, it's often the case that you buy the rumor, sell the fact. So if the Dow were to rally up until, or the NASDAQ or whatever, up until the November election, you'd expect it to fall off. Yeah, buy the rumor, sell the fact. So I'm not trying to do the short-term trade on those two. Nitin, let's say we had a very great stock. How do we determine entry price? You buy it. If it's a great stock, don't pee around, buy it. That's what you do. Look at 50-day moving average. No, buy it. If you find a great stock, buy it. Because presumably you're going to hold it for 12 months. Julian, what's your view on Chinese stocks besides usual Baba JD? Actually, at the moment, Julian, as a broad view of Chinese companies, I've just been staying clear. I'd only buy Chinese companies if, first of all, they're listed on the New York Stock Exchange. In other words, they're American depository receipts. I don't buy them in their local exchanges, the Shanghai B exchange or whatever. Because I quite like the fact that they'd then be regulated in the US and they're easier to buy. So that limits my numbers. I'm staying away from Chinese companies at the moment, partly because of the very unusual factors of, I just think the added notion of China tariffs worries me a bit. And I've got enough choice. I don't need to walk into that area. Now, you might say you're crazy, go for Chinese companies, that's fine. But I'm just telling you where I am with those. Nisha, do you think Apple is overvalued at the moment? So, Nisha, I don't actually. I'm an Apple shareholder. I don't think it's overvalued. Again, I can tell you several reasons for this. The words of Warren Buffett. He says, "I've got a private jet and I've got and I've got an iPhone." He says, "I spend a hell of a lot more time with my iPhone than I do with my private jet." And he goes, "If you increase the price of iPhones by tenfold, the company would be even more profitable. Would have fewer customers, but it'd be more profitable." That's a tongue-in-cheek what he's saying. The real point with Apple is this. And there's some research to show it's not undervalued. There's valuation. There's price to earnings, for instance, the share price relative to the profits it generates. Then there's the share price relative to the future profits it might generate. Then there's revenue growth. There's cash flow. Then you've got to look at, in the whole, you've got to look at consistency of returns, the average returns. So it's not the valuation I'm bothered about. And actually, that's not your question. It's not valuation. I don't care whether it's innovative or whether it's valued or whether they've got a good workplace culture. Okay, all of these things might be relevant. What I actually care about is it likely to be higher next year than lower in relation to all the other stocks that I might own? And by the way, how many stocks am I likely to own? Well, let me tell you how many I'm likely to own. Whoops. Let me just show you these, okay? The general market consensus is you should own about, well, after you own 15, the risk diminishes. So then the question arises, well, is it more likely than not to be one of the best 15 I could own and higher by next year? Yes. So in one sense, it's not about valuation at all. And then I've got to allow for the fact that it might fall. Roman's asked about IPO Airbnb. On the whole, I've written about this in my Financial Times column. I try and stay away from IPOs because there's very little information and it can be volatile. There is a strategy around IPOs that I suggest if people really want to use, which is if at the end of the first day it falls below its entry price, just wait until it goes above it before you go back. I mean, it's a bit complicated and messy. On the whole, I don't. Buffett doesn't. It's a bit too speculative. I really like my companies to have more data than that. And of course, that would have meant on some recent IPOs, I've missed out. So be it. I exchanged certainty for risk. Okay, and I'm happy to do that. But Airbnb, not for me, I'm afraid. Tanya, do I buy Apple and Amazon now or wait for dips? Oh, no, it's a good question. If you're holding for 12 months, I don't wait for dips. The very good question on that, and a lot of people are concerned about, well, wait a minute, what if the markets fall? Okay, there's so much uncertainty. What should we do? Well, one solution is something called, and this is from Fidelity, called pound cost averaging or dollar cost averaging, where basically what you do is you put an equal sum. So you put in, say, instead of £3,000 or $3,000 today, you put in 12 monthly installments of £250 each month. Now, I'm not saying you do it for 12 months. You might do it just across 3 months. You might put £1,000 in this month, 1,000 next month, 1,000 the month after, and you buy whatever number of shares you can in Apple or Microsoft in each of those months. Why? Well, because you're not putting all your money in equally, because if the market rallies, you're screwed. So we're not trying to time the dips. We're not trying to time the dips, Tanya. Okay, so pound cost averaging, this is from Fidelity. It's a common practice, and that's why I share it and share it with people. You might not spread it over 12 months. So if you're risk loving like I am, you just buy the bloody things now. If you're very risk averse, you don't even go into shares, or you wait. Okay, until you're more certain and feel more comfortable. If you're in between, as most people are, you pound cost average. The amount of which the time frame you'll take will depend upon your risk aversion. Kid, Alpesh, are your performance stock picks as flag still current? Example, if they're already up 20% since March lows, is it not too risky to chase them now? Lots of things in there. I don't put a cap on gains. Okay, so I don't care on a cap per games, and each month I look at I hold things for 12 months. If they whatever returns they give me 100%, great, and if they fall from their highest point by 25%, you get out. So trailing 25% stop loss, okay, for the longer ones. So simple as that, kid. Nisha Allens, you've mentioned Buffett several times. Do you own Berkshire Hathaway? I don't own Berkshire Hathaway. I own a bunch of others. I just gave his views. If you want to know what he owns, what does he own? There's what he owns. If you want to know what Buffett owns, he owns, there's 44 stocks he owns. Of his top 10 holdings, whoops, you can see his top 10 holdings here. He owns 44 stocks. Apple, he owns 44% is in Apple. And then, what's that, BSE? Bank of America? Coca-Cola and so on. Well, he bought the Ziggo, American Express. I wouldn't buy American Express necessarily today, but I'm just saying this, just because he owns it doesn't mean I buy it. And just because I talk about a wise thing he said, I mean, the Buddha said wise things. I don't own the same stocks the Buddha owns. So yeah, that's all I'm saying regarding that. And by the way, don't just go and buy these just because they're on here. I still need to filter. It's only when I filter do I come down to, I want to filter so I get purity. Do I come down to my sevens and so on, and my cash flows, etc. and performance and so on and so forth. Remember my ultimate, and these are just some of the ones I've got. I've shown you these before. Alan, there's quite a big difference in doing this in the USA, brokerage at zero cost compared to UK accounts at significant cost. No, Alan, you're wrong. This is a common misconception. First of all, you can buy American stocks. They can go in your SIP and your ISA, and the commission difference between a zero cost US broker is that they put it in the spread. You don't think they're doing it as charity, do you, Alan? They put it in the spread. A UK one will charge you £10 to own a foreign stock. So you're right, there is a huge cost. You'll own Apple and you put £1,000 in, let's say you doubled your money in a year or 10 years or a million years, and it would have cost you £10 more. So a lot of people say to me, Alpesh, I'm going to spend that £10, but I'll say to them, well, what if it was Microsoft or Square or Zoom and you made 50%, you made £500 again. Now, I don't want to make £500 because it'll cost me 10 quid to make it in commissions. I don't want to spend £10 to make £500 now. Don't be daft, Alpesh. So, that's up to you. If you don't like commissions, then you wouldn't do it. You wouldn't do it in that case. Suman, any reason Apple and Microsoft could lose their halo status with you? They don't have a halo status with me. I think they have it with the market. They're just soaking up all the talent. They're monopolies. They're monopolies with an unfair competitive advantage that they soak up all the creative talent. They wipe out their competition. Halo, I'd probably say devils. Amazon as well. You got to remember what these companies are doing. They can outpay any competitor who wants to hire the best talent in the world. They will wipe out the competition. They will underprice them. They will outmarket them. They will throw money at the market until you are out of business. And then they will take your staff, your intellectual property. They will destroy and crush you. Welcome to capitalism. Okay, so Halo? No, what's the opposite of Halo? Devil's horns? is probably the equivalent. Okay, so that's that. Are there any questions I've missed so far? Keep the questions coming if there's anything I've missed. Oh, the final point of all of this. Remember, one of the things that we're looking to do, and it's been very investment focused. I've not even had a chance to do the trading side of things. The sort of, you'll all know I've got two parts of it. I do the investing and the trading. This is what we're after. Okay, this is actually a US government site, but whether it's dollars or pounds doesn't matter. You can convert it to pounds. Okay, it's all the same, right? That's 10,000. You start with 10,000 in year 0. By year 15, if you're adding 500 a month, which is this, okay, 500 a month, pounds or dollars, then after 15 years at a 20% per annum, you end up with 600K. That's our goal. We want to turn every 10,000 into 600 over 15 years, but we need a 20% return to do that. How the hell do you get a 20% return? Well, these companies historically generate that. They're not the only ones. 20% return. Well, have a look at some of those figures. Okay, not every stock's going to do it. It's our portfolio as a whole. Let's say our portfolio 6 months ago only had this. Well, you can see it's achievable. Did we pick these? Do we have to have these? These are today's. My 6 months ago were some of these. My point is it achievable? Yes. Are there every company doing it? No. How do we find the ones which do? Cash flow, valuation, growth, income, filter until it's green. It's like purifying water. Until you drink it, in my case, until I give water to my child or my portfolio to my son, it's not good enough. Tanya, would you put extra money into investment or towards mortgage repayments? That's a brilliant question, Tanya. I'm going to go back to Warren Buffett. Now, the reason is not because I don't have confidence in my own views, but I think it's always great when you can corroborate your evidence. Buffett said the only long-term debt worth having, because it's cheap, is mortgage debt, not credit card debt, because that could be 20% per annum you're paying, or 50. God, how are you going to beat that in the stock market? You're not. Okay. He said the only long-term debt worth having is mortgage debt, because it's the cheapest debt there is. It's the only one he allowed. He said, I don't like debt. And he's right. I don't like debt either, because it feeds off, if you can avoid it, it's not good. So what would Buffett say? All right, he would say, well, better to invest, because if you're borrowing money on your mortgage at 5%, okay, and you're achieving, and you've got the time to achieve it, and it's risk capital, okay, risk capital caveats, and you've got the time, let's say 5 years, 10 years, and you average even 10% per annum, hey, it makes sense. As long as you exceed the long-term mortgage cost, it's a rational thing to do. Jonathan, do you use alpeshpatel at tradermind.com? Yes, Jonathan, that's my email. Dan, one easy question. Do you reinvest all dividends you receive back into share purchases? I do. Yeah, Dan, I just tick that box on the, I don't faff around. The brokers ask you, do you want to reinvest in dividends or blah, blah, blah. I'll just tick the box. I hate filling forms and ticking things. And so I just tell them, just put it all in. So yeah, I just do it like that, but that's more for simplicity than mathematically it makes sense as well, but any other reason. Sean said, are there any other markets that have performed as well as the US that you can? Sean, I just happen to show the US not as a way to say buy US, because look, there's a lot of rubbish companies in America, okay, which haven't performed. This is just, I'm bottom up. I'm not top down. Bottom up means I look at the companies wherever they come from. So yeah, the Indian market's done incredibly well, but are you about to go and do it? I'll tell you why you won't, because 99% of the companies would rip your head off. You wouldn't succeed. It's the 1% which have done incredibly well, but as the market has done well, because they measure only the 1%. You go in and say, I want to buy some Indian stocks, you'll end up with some rubbish ones and lose all your money. My point is, I'm not index tracking and saying buy the US. What I'm saying is I want a bigger global choice, which happens to include American companies and British companies and Indian companies in the US. So I own some British companies as well. I own some American companies. But because I'm British, I've got Americans working for me. I've got Brits working for me. I've got Indians working for me. And I take all the money they make for me and bring it back to the UK, because I live here and I buy my food from the local supermarket in the UK and feed and eat in the UK. So yeah, great. It's great for the UK. Okay, listen, guys, I only wanted this to be a short, quick one and answer any questions you've got. I hopefully have answered all the questions. Tanya, at the moment, Apple has arbitrary good. Oh, no, Apple, remember, Tanya, what we said when we had the call? There's 5 companies which I sort of put in my quality rating. So I'm not bothered so much about value, growth, income, momentum with those. They're my sort of flight to safety stocks. And the three I've already mentioned of those, Amazon, Apple, and Microsoft. And by the way, I don't want, because I kept mentioning them, they're famous names, and that's why it's easier. Don't forget, these are the ones I also own, okay, as well, you know. Come on, Phil, Shepard, I know. Phil, they do have a long-term commitment, so don't worry. They have a long-term commitment. Don't worry, they've told me. Come on, are you expecting a correction? Oh, come on, yes, good question. The beautiful thing about it is, are you expecting a correction or drop soon? It's like the Spanish Inquisition. Nobody expects the Spanish Inquisition. I'm not. But then again, let me tell you what happened in March. I said there's a 60% probability we'll fall below our March lows and a 40% probability we'll rise. Guess what? The 40% was right. Did that make me a genius? No. Did that mean I had a time machine and a crystal ball? No, because I said 40% will rise. 60% will fall. You could argue, well, you were wrong then, weren't you, Alpesh? I was wrong, but I made money. Why? Because the 40% I was right. I just kept the stocks that I had. And it's the same thing with this. I don't expect it to fall. But even if I'm wrong and it falls, the kind of stocks I've got won't fall as far and they'll rebound quicker. Viola, do you think it's still safer to put money into stocks and manage it yourself instead of a company pension? Do you know how it usually compares? So, Viola, it's a good question. What you mean by instead of a company pension is this. You mean instead of a fund manager. See, a company pension or a SIP, where you're investing yourself, is still you managing it in a pension. The benefit of a pension is this. You're saving for the long term and it's tax-free. Whether you get a fund manager to manage your pension or you manage your pension yourself is what you're really asking. Now, I personally, because I'm financially literate and I want everybody else to be financially literate, would encourage them to learn how to get those 15 stocks which would give them that over a long period of time. Other people say, no, I'm going to give it to a fund manager. My worry about fund managers is this. They tend not to outperform the market over long periods of time. They charge you fees. They usually charge you about £1,000. If you put £10,000 with them, it'll be £1,000 every 5 years. So 10% of your money will go to them every 5 years. And I've written about this extensively. I'm not the only one. Others have as well. That fund managers do not perform well. Okay, so those are all my reasons. However, if you said to me, Alpesh, I'm completely financially illiterate, I don't have the confidence to do it, then I'd say, well, rather than a bank account, give it to a fund manager. Rather than a fund manager, do it yourself. So there's a grade, okay, of doing these things. So hopefully that will help. Nisha, how off? Whoa. Side, is it better to hold off buying tech stocks still after the result? Depends on your risk aversion. I'm not risk averse. I have no problems buying the kinds of tech companies that I filter into. Okay, I filter. So I don't have a problem owning them because I think they'll fall less far. But if you're very risk averse, you would wait. I don't wait because I'm not gambling around the election results, as I said earlier. I'm not gambling whether it's going to be good or bad. I don't know whether it's going to be good or bad. We are all making decisions under circumstances of uncertainty. So it's that case, a bit like going into battle. Therefore, I need to plan. Okay, there's an old saying, piss poor planning leads to piss poor performance. In other words, if we don't plan, if we don't plan, we fail. Basically, I look for filter, which means if there's a market correction or the election doesn't work out the way I want it to, my stocks will not fall as far and rise back sooner. What does it mean the election won't work out? I don't know, because the market hasn't decided whether Biden's good or bad, or Trump is good or bad, or who's going to win. Nobody knows. Okay, that's why you have to do it that way and think of it that way. Nisha's asked, how often would you review your stock holding and change it? Okay, very simple rules, and this came from Deutsche Bank. 12 months is a good holding time frame. Why? Because 1 day is too short and 1,000,000 years is too long. Okay, they discovered that 12 months is a good way. And if it falls 25%, okay, from the highest the stock has been since I bought it, there's no cap, there's no target, because some of them go up 100%, some go up 1%, right? 25% stop loss. Trailing, so if it goes up and then drops 25%, you get out. Otherwise, you just keep it for 12 months and then you review. And you might still review and rebuy the same stock after 12 months. Simple maths. Okay. Other than ISAs, pensions, what are the most tax efficient ways to buy stocks? ISAs and pensions are tax-free. Spread bets are tax-free. That's going to raise a whole load of questions. It's tax-free. Okay, as well. There's no capital gains tax on selling, but there is a finance charge to do with that because you're buying on margin. More technical than this. Tanya, is it highest from what the stock has been during the holding period? Yes, it's the highest it's been since you bought it. So if it drops 25% from the highest it's been since you bought it, then sell. because, you know, it's a safer way of doing it. Rupen, no, I've answered that. Saeed, are there any other sectors that are on the uptrend other than tech? Saeed, I'm bottom up, so I don't care what sector they're in. So yes, there are other sectors. Here they are. Costco, wholesale retail. Are you kidding, Alpesh? Wholesale retail is not on the up. No, it's not. I'm bottom up. Costco is. It's up 21% though. So is retail? Okay. Telecoms. Actually, I don't know what Tenacor is. I'm wrong. KLA, I don't know what they do, but they're up. So this is how much they're up. They're not all telcos. Pharmaceuticals, there you go. Pharmaceuticals is a sector. I don't buy sectors. I buy stocks. Okay, because I can filter. Because it's the company that I'm bothered about. So you need to have a trading stop loss of it. You wouldn't need to, Tanya. You can just observe it and monitor it and just look at it every day or every week. You know, you don't have to be exactly precise. You can say at the end of each week, what's the highest it's been? You know, write a number down. Okay, you don't have to make it too complicated. The kid, mine, my stuff. I'm afraid. Okay, guys, I better go. Any other questions? Please email me. I wanted to keep it short and sweet. And I hope I have. Any other questions? Just email me, guys. I hope you found all of that very useful. It's a short and sweet than the normal webinar for my students, but I wanted to do that because I wanted the opportunity for you to ask me any other questions on where we've got to and what I think. Like I said, this is where we are with the Dow. What I think is most likely is there. You can see it on screen. Regardless of the election, I'm not making guesses on the election. I might be wrong. If I'm wrong, it doesn't matter because my individual stocks are the ones which don't fall as far, rebound quicker. Don't fall as far, rebound quicker. How do I know they do that? Well, through everything that I teach you, you all know if you're on my course, that everything I teach you, it's value, growth, income, momentum, cash flow, volatility, average returns, alpha. It's all of those things. I filter until I've got 15, which are absolutely pure enough to drink. It's as simple as that. Okay, thank you all very much. Hope it was okay. Short and sharp this time, so I don't take up too much of your time. Hope you found it value added, my friends. Any other questions? Of course, I'm always available to you all. Thank you all very much. I've got a lovely personal statement announcement to make all of you, so keep an eye open with the replay of this as well. I will send you that if you haven't already Googled it. I'll send you that lovely personal statement later on today, hopefully. Okay, thank you all very much.